Good morning, pre-market. Here it is, 8/9/2011, 5:57 a.m. Market opens up in 33 minutes. Yes, it does. Now, we've gotten to a point where overnight market futures overseas, and last night, the Dow futures were down 265 handles. And that the futures volatility in after hours and pre-market start to hit their volatility cycles when short-term bottoms are going to try to get put in. Now, prior to doing the video on the trade management for the day, the SMF MMTs have had very sophisticated training that is not available anywhere else. And they're mathematical equations that equal weakness and strength, and the difference between a bull rally trend and a bear, and how a market goes back into its bear. It never left. Bear market never left since year 2000. You've had great bull rallies. Go look at stockmarketfunding.com and look at the history of the Dow. If you're tired of getting hammered, hey, we give you free people enough to think about before it happens. Or you can go to CNBC, or you can go to all the other rat joints out there on the internet and compare what we know, compare what they know, and then compare who is right when it comes to trade management. And so that your retail mind and your retail way of thinking through the market will eventually change. The trade management is that from the bottom up cycle, using pre-market futures on the gaps, again, is that we're in bear market territory, and I've got the S&P chart right here behind me. We broke through the 100-week and the 200-week, and the amount of drop is that we were talking about shorting up here, and we did, and how you would fail, and how you would break it, and we did, and how the weekly moving averages are declining mathematically, and there is formulas in here that we used to establish the markets. Now, the upside volatility from the short-term selling is that once you hit the upside volatility on the opening bell is in your SMF trading application, is that it will validate the bid and ask ratio and the IR. Not only that, that when you do gap, you don't fill the gap, but from the mathematical formula of the gap, that you pull back and you hold at least 70% of that gap price without undercutting it, you would stay very strong, and in the application will validate that, MMTs. So this is the volatility opening of 1.00 ratio and higher in pre-market. Google leading the way because it's still the #1 trend out here. The Apple is still a good trend, and the margin debt, the volatility is that when they hit their intraday highs, they will roll over. But when they do roll over in this particular phase of where we're at, is that the contraction mathematical, that the pullback is contracted. It's not giving all its gains up, but contracted, and then they break, and they break higher within the volatility, upside volatility, versus the short volatility that we've been doing. Nonetheless, when it does make the final intraday high, it'll be the same way that it was all 4 weeks in our trade management. And we have it all on stockmarketfunding.com and pre-market as to how these markets would trade from up here. When they gapped, you would sell. When they gapped, you would sell. When they gapped, you would sell short, short, short. Every gap short. Sorry, 100% accurate. Hey, can't deny the truth, can you? Nor should you. So that trade management is still in the market. The thing of it is, on the upside volatility from the oversold condition within a new bear trend has developed, is that selling into the rallies, as we said over here all year long, we told people, sell into the rally. Go long the rally, sell into it short. Go long the rally, but kept selling short, and that top-down trade has been the trade. And any rallies that do happen in a shorter term at a bottom in an equity and in indexes or bulls and bear ETFs is that the mathematical ranges, the mathematical SMF ranges, delta ranges, teeny ranges, half delta ranges will remain the same. Where you see the elevated fear is that in the VXN and the VIX, the volatility fear indicators, from complacently to extremely fearful, is that on the intraday level, MMTs, that those fear indicators have to be dropping in value and value. They can't come back from the high and hit support, and then if they turn around and go up again, then equities are going to keep falling, just as you've been taught. So the thing that we'll monitor is the weekly and the daily VIX, which is equal to the S&P 500 fear indicator. The Nasdaq comp is the VXN. And that the higher at support levels is there is more fear in there, and that means that people are going to continue to sell into rallies. And that's on the Nasdaq comp pre-market and the extreme volatility that it is. The trade management that we did over here, and we did all across these tops, that's the thing. And the thing about the mechanical part of it is that the bottom up will be sold. You will take your profit and get immediately short. The amount of selling and upside buying, so downside volatility and upside volatility, have a mathematical equation that will tell us exactly where the volatility is outside of looking at a chart. Because when you look at standard technical analysis, you can't make heads or tails of it. Trade management remains the same, and the upside volatility of getting net long and how they consolidate up toward the highs, and are the people finding the value, because everything is going to hit a bottom. And trading volatility in bear markets is the best you make. You can't ask for anything more than this.